Kering is one of the world's largest luxury companies with brands like Gucci and Saint Laurent. But in the last few years, their performance was far from good and their valuation is close to the lowest point of the last 5 years. This brought the current dividend yield to 5.8% and might present a very appealing buying opportunity for dividend investors. And with the turnaround strategy already in progress, this opportunity might soon be over. So, in today's video, I want to share my analysis and thoughts on Kering with you. For that, I'll have a look at their business model and markets, analyze their mode, and look at the latest financial statements, including the last quarterly report that they just announced this week. My name is Florian. Welcome to Cashflow Maniac. Kering has the ticker symbol of KER and they are listed on the Euronext stock exchange in Paris. They are working in the consumer discretionary sector and were founded in 1963. At the moment, they have around 46,000 employees and their headquarters sits in Paris, France. Their market cap is at $31.7 billion at the moment. The total returns, including dividends over the past 12 months, were extremely poor of the company. They did produce negative returns of almost 39% for their investors. Unfortunately, this poor performance has been going on for a couple of years already, and the company's stock price did decline by around 70% since their highs in 2021. These bad couple of years also had quite some impact on the performance over the last 10 years, and all in all, they could only produce 90% returns during this time. But we wouldn't be talking about Kering as a turnaround chance if the performance would have been good. So for me, the question is more, what do their financials look like and can they turn the boat around or not? But let's not get ahead of ourselves. Before I go over the financials, let's have a look at the business model first. Kering is a French luxury manufacturer with many different brands that they call houses. Their brands operate in the fashion, leather goods, jewelry and eyewear segments. The most famous of the brands is probably Gucci, but they also own brands like Saint Laurent, Bottega Veneta and Alexander McQueen. As one of the key players in the luxury industry, they put a huge focus on traditional and high-quality craftsmanship and combine this with a modern design. By far the biggest portion of their revenue is earned by Gucci, which accounts for almost 45%. This is followed by Saint Laurent with 15.8% and their fairly new eyewear segment with 11.7%. So, Gucci makes up the biggest amount of their revenue and is by far the most important brand of the company. Geography-wise, the company's business is somewhat evenly split between the three main regions: Europe, North America and Asia. Similar to other luxury companies like LVMH, Asia still made up the biggest portion of their revenue until their last quarterly report, where the picture switched and Europe is now ahead. North America accounts for only 23% and is a bit behind the other two major regions. Unfortunately, their usually biggest region, Asia Pacific, is also the one that has performed the worst recently. While basically all regions except Japan are down, the business in Asia has declined the most by far. One of the reasons for this, in addition to the weak Chinese economy, is that due to the weak Japanese yen, many Chinese customers are going luxury shopping in Japan right now, which also explains the increase in their Japan business. We see the same trend in other luxury companies right now, and I also went over this in my top 3 dividend stocks video from 2 weeks ago when I talked about LVMH. But this weakness in Asia is just one of the reasons for their bad performance. The exuberant designs of their old creative director Alessandro Michel that were appreciated by critics but unsuitable for everyday use besides the red carpet also did their part in the poor performance and deterioration of the Gucci brand in general. And in addition to this, Gucci also seems to have troubles with reaching the right target audience with their current marketing. So there are a multitude of problems brewing at Gucci right now. But they already started to take countermeasures. Just a couple of weeks ago, on 8th of October, Kering appointed Stefano Cantino as new CEO for Gucci, who will take over on 1st of January. And in September last year, Sabato De Sarno started as a new creative director and immediately changed the design language to sleeker styles that are also more useful in everyday life. Right now, there is not yet enough of this new style available, which according to Kering had a very favorable reception up to now. But they are also putting more focus on exclusivity, which is very important for the top luxury purchasers who want to stand out more. For this, they are also working on more personalization and a better client experience, which includes the currently ongoing upgrade of their stores and a new media campaign. It is also not the first time that Gucci and Kering are in this situation. In the early 1990s, they were in almost exactly the same position. But a change in the creative director of Gucci and a bigger focus on exclusivity turned the ship around, and by the mid-1990s, the company did recover. And throughout its history, they have actually faced similar situations a couple of times and could always recover. So I see no reason why it should be different this time. And when we look at the market share and popularity of their brands, they are still in a top position despite the current weakness. Market share-wise, they are only second to LVMH and still have a very strong position. They are also still very popular with millennials, who have been a tough nut to crack for luxury brands in general. And these younger generations will be the future main customers for Kering, so this is definitely a good sign. At least in the US, Gucci, together with Louis Vuitton, are still the most popular luxury brands as of March 2024. So it seems like Gucci as a brand has not suffered too much from the current weakness and is still in a good position to recover from here if they play their cards right. The overall luxury market should also keep growing over the next years. The annual growth in the US is expected to be around 6.5% until 2030, and globally it is even expected to grow slightly quicker with a CAGR of 6.8%. In their most recent luxury market study, Bain & Company have identified 4 major transformations that should take place. The first is that Chinese customers should become the dominant nationality for luxury goods and grow quicker than the rest of the world. This also ties in with their second transformation, where mainland China should overtake the US and Europe and become the biggest luxury market. And while these two trends should benefit Kering over the long run, I believe that LVMH is actually in an even better position to leverage this. Thirdly, they believe that younger generations will become the biggest buyers in this market. And here, Gucci seems to be in a prime position to benefit from, with their popularity with younger generations. Last but not least, they expect that monobrand stores and online sales will become the leading channels to buy luxury goods, which Kering also already addresses. So I think that they are already in a good way to benefit from these latest trends, and their main brand Gucci is still well known and popular. This not only helps them to fend off new competitors that might try to enter this segment, but also to have a nice pricing power against their customers. So I do believe that they have a moat, but the competitive rivalry in this sector is very high, and particularly LVMH and Hermès seem to be even stronger and in higher demand right now. So now that we understand their business with its current weakness, the actions that Kering is planning to address them, and the general market trends, let's have a look at the cold hard numbers. In general, Kering could grow all of their financials nicely since 2011, although there have been some years with weaker performance sprinkled in. But Kering is trading at the same price they had back in 2017, and since then, they could grow their fundamentals quite nicely. Unfortunately, this has not been the case last year, and this year's financials are further declining. Their revenue from the first 9 months of this year is down again compared to the same time frame from last year. And especially Gucci shows quite a weak performance here and is 22% behind the performance from last year. Only Bottega Veneta and their eyewear segments could grow. And we also see this in the operating income, the gross margins, and the cash flow from operations that are all down from last year again. So, over the last 5 years, this resulted in an annual revenue growth of 4.4%. The free cash flow did even decline by almost 18%, while the EPS could at least grow a little bit with around 2% per year. So, the last 5 years have really been quite hard on the company. But despite this, they could manage to keep their margins quite high. Even though the numbers are also slightly going down here and will come down even a bit more as we just saw, they are still fairly stable on quite a high level. The free cash flow yield sits at 2.9% at the moment, the EBITDA margin at 33.6% and the return of invested capital at 11.4%. At the moment, they have almost 10 billion in net debt, which is 1.8 times their EBITDA from the last 12 months. So even though this debt did increase a bit in the last year, it is still on a manageable level and well below my threshold of 3 times. The company did also buy back shares, and over the last 5 years, they had an average annual share dilution of minus 0.4%. But share buybacks are not their first priority. In general, they are aiming for a healthy financial situation and free cash flow generation. And for this, their first priority is to invest in their organic growth and M&A opportunities. Then they focus on their dividend payments before buying back shares. And talking about dividends, Kering currently pays a dividend with a high yield of 5.8%. And they could grow this dividend over the last 5 years by 12.3% annually. Unfortunately, this growth, combined with the declining financials and high capex in the last year, have led to a free cash flow payout ratio of 92%. So at the moment, there is not much room for further growth, but I'd expect that this will recover again. What makes me believe this is that the capex of the company has been especially high last year due to the launch of Kering Beauty and the acquisition of Creed and the stake in Valentino. This has put quite some pressure on their free cash flow last year. Their actual goal for dividend payments is a payout ratio of 50% of their recurring net income and available cash flow. Now that we know the current situation, let's also have a look at what analysts expect of the company in the next few years. There are 26 analysts covering the company at the moment. These analysts give an average price target of around €260. This is around 10% above the current price. And the upside is with 45% quite a bit higher compared to the downside of 12.5%. And don't forget that these potential returns come on top of the dividends. But the EPS is expected to decline quite a bit this year. From next year on, the expectation is that it will grow again with a CAGR of almost 16% until 2027. This would be almost 10 times the growth that we saw over the last 5 years. For the revenue, the picture looks similar. This is also expected to decline this year, but starting from next year, it should be back to its old trajectory and is expected to grow with around 5.3% until 2027, which is around 1% higher than what we saw over the last 5 years. But of course, this also depends on the success of the current strategy shift. And the risk of this not working as expected seems to be priced in already. The current valuation of the company is in all regards below the sector medians. Their PE ratio is currently at 13.8, their EV to EBITDA at 10.4 and their price to free cash flow at only 6.9. This is also quite a bit below the 5-year averages of the company and close to the lowest values in this time. And when we consider that the growth from next year on should be even higher than the numbers that we saw from the last 5 years, this seems like a very attractive entry point. So before we sum this up in a minute, let's also directly compare them to their closest peers. For this comparison, I choose LVMH, Hermes and Lululemon, but also Ferrari. The reason I chose Ferrari is that I made a video about them a couple of weeks ago and have had them on my watch list ever since then. So I am very interested how they compare directly against Kering. And in the last 10 years, Kering had by far the worst performance in terms of total returns of this group with only 82% total returns, while Ferrari actually did the best. With 818% returns, their performance was more than 10 times better than Kering's. Dividend-wise, our company today has the highest yield by far. And the dividend growth is also quite good with over 12%, but was still beaten from LVMH and Ferrari that takes the crown again in dividend growth with an amazing 70.6%. The valuation of Kering is also quite a bit below these peers that all sit well above the sector medians. But unfortunately, the growth numbers were also by far the lowest. In this category, Lululemon actually takes the crown here in most metrics and especially the 5-year growth CAGRs. But in profitability, Kering still plays on very similar levels as LVMH and Lululemon, with their gross profit margin even being the highest from the whole peer group. But their net margins, income margins and free cash flow margins are a bit behind the other companies. Before we sum this up, if you found this video interesting, please hit the like button and subscribe to the channel so you don't miss out on my next analysis. It also helps me out a lot and doesn't cost you a thing. So thank you very much. And now back to the question, is Kering a good investment and can they turn their business around? And yes, the performance of Kering hasn't been good in the last few years. But again, we wouldn't be talking about a turnaround chance if it would be otherwise. And it seems to me that they already have their strategy to turn this around in place. Unfortunately, I am not enough of a luxury enthusiast to qualify if their new design strategy is good or not. But I like that they already took action. And it is also not the first time that the company is in this situation. In the past, they have pulled off such turnarounds quite successfully already. And this fact, combined with their still strong brand names, gives me quite a bit of confidence that they can also do it again this time. Over the long run, I still like LVMH, Hermes and even Ferrari quite a bit more, but I think that because of the very low valuation and expectations in Kering, they do have an edge for the next few years and could produce maybe higher returns even. For investors that look for a high dividend yield, it might also be a good time now to lock in the almost 6% dividend yield. But I would not rule out that we have not seen the bottom yet and the stock could decline even further before recovering. In general, I'd wait a bit more to see if the current actions are effective before investing. But please, before investing, do your own research and only use this video as a starting point for your own analysis. And I mentioned Ferrari a couple of times now. With a dividend growth of over 17% over the last years, they are especially interesting for investors like me that are specifically looking for high dividend growth. If this is something that might be interesting for you, you should check out this video. That being said, thank you so much for watching guys and see you in the next video.